We begin in the UK, where the Bank of England has increased its benchmark interest rate by a quarter percentage point. That's brought the rate to 4.25%, while the inflation target is 2%. This is the 11th consecutive rate rise, and just a day after the announcement that inflation has also gone up and the US Federal Reserve put its rate up. The UK's February inflation rate hit 10.4%, driven by high food and energy bills. Paul Brennan has more from London.
The inflation that was announced on Wednesday from 10.1% going up unexpectedly to 10.4%, rather forcing the hand of the members of the Monetary Policy Committee of the Bank of England when they made their decision this morning. I have to say there are some chinks of hope in the predictions that the Bank of England are putting forward. They're saying, for example, well, first of all, it was not a unanimous decision. It was 7-2 in favour of increasing the interest rates from 4% to 4.25%. The other two members of the Monetary Policy Committee actually would have preferred to keep interest rates where they were. So there are signs of a weakening resolve from the MPC there. The other thing is that the Bank of England no longer predicting that the UK economy will go into recession. There is an expectation that the economy will grow, in inverted commas, slightly over the next year. So a little glimmer of hope there. The other thing, though, is that they also expect energy prices, or the energy price contribution to inflation, to turn negative during the course of this year. We, of course, had the Ukraine war, which bumped up the price of energy, namely Russian gas, because of the shortage of that. That is expected to come out of the inflationary pressure over the next year, those pressures easing as people find alternatives. That said, though, it is still an increase, and there are concerns that as the central banks around the world continue to try to put the brakes on inflation, it might spill over into a wider recessionary pressure on the economy. So it's a very delicate balancing act that these central banks are having to try and tread.
Well, Vicky Price is an economist and board member of the Centre for Business and Economic Research, and she says the latest interest rate hike wasn't a surprise.
The UK tends to follow what the Federal Reserve does. It has done it in a number of cases during the period of raising interest rates that we've seen in the last few months. But what could have been expected just a few weeks ago would have been a 50 basis points increase, and then maybe the end of the cycle for interest rate increases here in the UK. I think there was a similar discussion in the US as well, but we've had the banking crisis of sorts, if you want to call it that. The issues with a couple of specialized banks, smaller banks in the US, which required government intervention, and you've had in Europe Credit Suisse being bought by UBS. And the repercussions of that for other banks in terms of contagion on the share prices is something which I think has been taken into account. And the reason why we're seeing just a 0.25% increase here and in the US is partly because of that. And inflation has gone up, but it hasn't gone up only in February in the UK. It has gone up in a number of countries in Europe as well. And that's probably why the European Central Bank raised its own rates by 50 basis points last week.
And the Swiss National Bank has also increased its interest rate by half a point. Switzerland's key rate now stands at 1.5%, and the bank signalled more hikes were possible. The move comes on the heels of turmoil in the Swiss banking system. The state brokered a deal for banking giant UBS to buy its troubled rival Credit Suisse on Sunday.